Okay, so I guess we'll get started. I just want to thank the chairman and the IAD for inviting me to this session. My name's Christopher Green, and I also want to congratulate the chairman on his pronunciation of my university, because I usually find this second slide helpful. People outside Loughborough don't usually know how to pronounce it. So thank you very much, Mr. Chairman, for that. Well, let's move swiftly on from that. This, as you can see, is a joint paper. And I want to say a little bit about the background. The work was commissioned by the Central Bank of Kenya a couple of years ago to look into the interbank market in Kenya. The interbank market in Kenya developed from round about 2000, and by 2011-12 it was a very active market by the standards of many emerging economies, and the central bank simply felt that they didn't have enough information about the market. So in a sense, our brief was an exploratory brief to obtain information about the market, to document that information. And the project was divided into three. The first component involved looking in detail at the structure of interbank relations in the interbank market. The second was looking at issues of risk and solvency in the market. And the final one was seeking to track the performance of the market over time, looking particularly at the interbank rate, which obviously is the market, well, I say obviously, it is the market rate for that market, and the possible issues and impacts of central bank policy on the market. And it's that third project, the time series behavior of the market, which I'm going to talk about in this paper today. So let me just say a little bit about the market itself, first of all, just in general terms. And let me emphasize to begin with then, this is what I'm talking about is the overnight market for loans between commercial banks, in this case specifically in Kenya, but that's what the overnight market is in many other countries of the world. So you're thinking sometimes about loans made at 4 o'clock in the afternoon, repaid at 8 o'clock the next morning, very short-term lending and borrowing. And in many cases, it's the main alternative to borrowing from the central bank. So that if you think of central bank borrowing as last resort borrowing by commercial banks, the interbank market is the next to the last resort in terms of the management of their cash reserves. Now, a key feature of the interbank market is that the lending in that market is unsecured. And that's in contrast to markets of somewhat longer maturity, which are typically collateralized. And of course, all central bank borrowing by commercial banks is also collateralized. So one of the distinctive features of this type of market is the fact it's unsecured, and that raises a number of issues in terms of how the market is perceived related to other markets and how the banks use it. The second major issue in the interbank market, in any interbank market, is that bank reserves perform two quite distinct functions. The first function is that they play the central role in operating the payments mechanism. All the payments which you and I and everybody else makes ultimately have to be settled through bank reserves, and the requirement for this purpose is that banks should hold a huge quantity of reserves. Bank reserves also function as the sort of fulcrum of monetary policy. And for monetary policy, exactly the opposite is required, that banks hold as few reserves as possible so that the central bank keeps control over the supply of reserves. And it is trying to manage that tension, which is one of the main well, I'm tempted to say it's one of the main functions. It's certainly one of the main issues that any central bank faces, both to manage the payments mechanism, which has one set of requirements, but also to implement monetary policy, which has a rather different set of requirements. Now, the interest rate, the relevant interest rate in the interbank market is the overnight interbank rate. And this, because of the function structure of any interbank market, performs a number of important functions. Usually, it tends to be the operational target of monetary policy. In the US, it's the federal funds rate. In the Eurozone, it's the EONIA rate, and so on and so on. And in Kenya, it has become the case that the overnight interbank rate does perform a similar type of function. Because it's the shortest market rate, it also, well, we say it anchors the term structure of interest rates. Other interest rates tend to change following changes in the interbank rate, and therefore it is also really the first link in the chain of monetary policy. How monetary policy affects financial markets and the rest of the economy ultimately goes through or starts off with the interbank market. Now, a little quote here from the former chairman of the Fed, as I now have to say, Ben Bernanke. And the interesting feature of this quote is from mid-2008, somewhat before the onset of the worst of the financial crisis. And in this statement or comment, Bernanke is talking about repo markets and what can go wrong in repo markets. A repo stands for repurchase agreement. And the central feature of a repurchase agreement is that it's a secured agreement, in contrast to interbank markets, which, as I've emphasized, are not secured. So the point here is if things can go badly wrong in secured markets, in unsecured markets, the problems potentially can be even worse. And of course, in the summer of 2008, it was precisely in the interbank market where the freeze-up took place, and then we had all the rest, Lehman's and all the rest of it. So, moving on now to Kenya. Why do we want to look at Kenya? Well, there's a range of issues here. First of all, virtually all the work that we can find on interbank markets has been done really for four central banks, the US, the Eurozone, the UK and Japan. There are many other developing interbank markets, but there's no research that we know of on interbank markets in emerging economies. And this is quite important for the central theme of this conference, because a developing interbank market tends to promote, it essentially shares liquidity among the banks, and therefore promotes liquidity at the very short end. It helps with the market orientation of monetary policy. It helps to sort of move away from direct controls if you can operate through the interbank market. And more generally, therefore, it does aid in the development of financial markets. So in terms of what we're doing in this paper, as I said, we're looking particularly at how the interbank market evolved in Kenya, and more specifically how the market responds to different types of shocks, interest rate movements, and different types of policy interventions. We're rather late in the day. Let me give you an outline of the paper. We've dealt with the first issue, why interbank markets, why Kenya. So what I want to do in the rest of the paper is to sketch out these issues. I want to say a little word about models of reserve management. We don't really test any theories in this paper. I'd say it's more an exercise in obtaining information, but we do have some theoretical work, which I just want to talk about very briefly. I'm just going to say a word very briefly. I put a mitt against that section on Kenya. I will say a brief word more specifically about Kenya, and then I'll go on to talk about the data. And then the final two sections, the payments and monetary policy, these are the two issues which I drew your attention to at the start. The impact of the payments mechanism on the interbank market, and secondly, the impact of monetary policy, implications of monetary policy for the market. So let me just give you the basic model here. This is due to Boltensperger starting in 1972. But the basic model for which interbank, understanding the interbank market starts is a model in which we think of commercial banks managing their money from day to day And each day there is a flow of deposits in or out, which the banks essentially have no control over because it depends entirely on, or primarily, on the structure of payments during that day. So as a random flow of deposits in or out, simultaneously banks are making loans which they can control to some extent. So towards the end of the day, if it's the case that the banks have made fewer loans and they've received deposits, then they can accumulate excess reserves in the form of cash. If they've made more loans than they've received deposits, then they have to borrow from the central bank. And borrowing from the central bank has a cost. It has two types of costs. This pecuniary cost, IC, that's the interest cost, and this non-pecuniary cost, gamma, which one can think of in a variety of ways. But certainly in Kenya, collateralization is regarded as quite a significant cost of borrowing from the central bank. So the idea is that banks maximize expected profits from day to day, and we get from that one of these basic results in this area, which was first pointed out by Boltensberger, which is that the ratio of the lending rate, RA, to the borrowing rate, IC, has to be related, not surprisingly, to the probability that the banks will be short of money, or a bank will be short of money at the end of the day. And one of the main features of Boltensberger's original result was that for this type of borrowing, this type of central bank assistance to work, it has to be the case that the central bank charges a penalty rate, so that the discount rate, the borrowing rate from the central bank, IC, always has to exceed the rate which banks are making immediately on their money. Now that's a model without the interbank market. Once you add in the interbank market, there are a range of additional complications. The main one, which I just want to remind you of, which I've tried to stress, is that interbank borrowing and lending is unsecured compared to the secured lending and borrowing at the central bank. Okay, well, I'm going to skip the next slide. In fact, I'm sure my chairman will get to me, and I want to make sure I try to finish on time. So I am going to skip one or two slides. So what I'm going to go on to do now is to talk briefly about issues specifically related to Kenya, and more specifically policy issues. The central bank has as its two main targets an inflation target, and the more immediate target is a reserve money target. And it uses a range of instruments to try and achieve this. It changes the discount rate from time to time, it varies the cash reserve ratios, and it uses repurchase agreements in its open market operations. And the use of repurchase agreements is now standard among different types of central banks. Now, one very important issue is that in many countries, and the US Fed and the Eurozone are true for this, where banks are required to hold reserves, there is what is called a reserve maintenance period, in which banks can meet the reserve test on average over that period. It's typically 2 weeks or a month, depending on the country concerned. Now, if there is a reserve maintenance period, what that means is within that period, $1 of reserves on Monday is a perfect substitute for $1 of reserves on Tuesday, and so on through the reserve maintenance period. In Kenya, in common with one or two other countries, at the time we did this study, there was no maintenance period. The reserve test had to be met each day, and what that means is that $1 of reserves on Monday is not a substitute for $1 of reserves on Tuesday. You have to have the reserves actually on that day. And an important implication of that is that the quantities of funds matter very much in the determination of the interbank rate. Where there's a reserve maintenance period, the issues are more complicated in terms of the run-up to the reserve date. Other issues in Kenya include these 2 points at the end of the slide. Because there's no other short-term money markets apart from the interbank market, the equity market and the foreign exchange market tend to have some interaction with the interbank market. And the central bank has an ongoing argument with the commercial banks as to whether they're using the interbank market to speculate in some sense in the foreign exchange market. I won't go into that today, but so there are a range of issues of that sort which are discussed in more detail in the paper. Okay, turning to the data, we have quite a nice data set, some 200,000 observations giving all the transactions between commercial banks in the interbank market over 8 years, the amounts, the interest rate, the banks, and so forth. For the purposes of this study, it's essentially an econometric analysis looking at the market as a whole, looking at the average interbank rate and the total transactions in that market and the implications for policy. So let me now show you a picture. It would have been rather hard to tell you about this picture without the slides. So I'm going to go on to straight on to the next slide, which I hope I can find, and which should have the picture. So get that right. Right, so what this shows on the vertical axis is the interbank rate itself. On the horizontal axis is the daily turnover. So these are all daily observations over the 8 years we've got data. And what we're trying to look at in this chart, and we have a whole lot of other tests which are quite similar to this, but this is sort of like a summary of it. What we're trying to look at in this chart is the extent to which the market can absorb different types of shocks. A market which is working well ought to be able to absorb shocks without big changes in the interest rate. Turnover doesn't really mean anything at all. It's just as it were, the total of supply and demand. So as we can see, there is no discernible relationship between the interest rate and the turnover. So that's really a positive feature of the market. The only thing you might want to be interested in are these sort of observations right up at the top here. These observations reflect a particular initial public offering, Safaricom in Kenya, when there was a huge level of transactions in the market. But as you can see, this was all done without a significant impact on the level of the interbank rate. So I got another of those charts. I'm just going to go straight to the conclusion. As I say, we did a range of these types of tests looking at the relationship between the market and the rate. And essentially what we concluded from this is that this is quite a well-functioning market. It's a deep and liquid market because it is able to absorb changes in volumes and spreads without adverse price or volatility effects. Okay, so next we go on to looking at issues of payments, the payments that come through the system, which the commercial banks can't control. And what we sought to do was to try to look at the effect that these payments might have on the market. And we used dummy variable regressions for this purpose. Three main types of effect we looked at were, first of all, the initial public offerings. And as I've already hinted, these very large initial public offerings did have an impact in the market, but they didn't affect the rate itself. They mainly affected the volume and dispersion of transactions, but not the rate. Other types of things which you might think would affect the market, days of the week, people going to the bank on a Friday, and so on. Liquidity shocks, what I mean by that is things like wage payments coming towards the end of the month, the day when VAT has to be sent by firms to the tax office, and so on and so on. All these types of shocks have been shown elsewhere to have an impact in the interbank market. And in Kenya, the effects are surprisingly small. So again, what this suggests to us is this is a market which, as it's developed, is able to absorb these shocks quite effectively. Okay, the last part of this session then is to look at econometric modelling of the rate. And I'm just going to give you one picture just to sort of give you a grip on what we're trying to do here. There's quite a lot of action in here. So what this shows is the time series from 2003 to 2011. Remember, these are daily data. And the black and the red line are two spreads. So the black line is the spread between the interbank rate and the central bank's discount rate. The red line is the spread between the treasury bill rate and the interbank rate. The bars are all showing quantities. And as it were, the upper part represents periods when money is relatively easy, and the lower part when it's relatively tight. So the blue represents banks' excess reserves. The salmon colour represents the amounts which the central bank took out of the system in cash each day. And if you look down to the lower part, the rather less frequent purple bars are the amounts that the central bank injected into the system, and the green bars are the amounts that the banks borrowed from the system. So one can observe towards the end of the period the sharp build-up in excess reserves, and unfortunately our data did stop in 2011 because quite a lot of interesting things happened after 2011, and it would have been nice to be able to incorporate this into the present setup. But what we're seeking to try and understand and to explain is the daily movements in the interbank rate itself. So again, I'm going to skip. I've got another chart, but I'll skip that chart and just go straight on to the details of the modelling. What we're going to do is to use what's called an error correction model. On the left-hand side, we're going to have the change in the spread between the interbank rate and the discount rate, with various interest rates on the right-hand side, and also various supply and demand variables. So policy variables, dummies relating to transactions variables, and demand-supply pressures such as changes in excess reserves. And importantly, in this type of setup, we have what's called the error correction term, which is the value of the spread, the level of the spread between the interbank rate and the treasury bill rate. Really what we're looking for is whether the interbank rate and the treasury bill rate are in some sense held together over the longer term. We also study the volatility, and the slide I've just slipped past you gives you the information about that. Again, I'm conscious of the time, so I'm not going to talk about the volatility. I'm just going to give you a couple of results from this, and I hope I'll meet my obligations to the chairman to stop on time. So these coefficients, these numbers show the coefficients in the regressions. I'm just going to pick out 2 or 3 for you. First of all, and a finding that caused some anguish actually at the central bank, what we find is that changes in the discount rate don't have any immediate effect at all on the interbank rate. So the same day effect on the interbank rate is 0. The -1 there is because what we've got on the left-hand side is the spread. So the spread changes 1 for 1 with the discount rate, implying no change at all in the interbank rate. But actually, it may be worrying from the central bank, but that's what you observe in a well-functioning market. It's true of the Fed, the Eurozone, and elsewhere. When the central bank changes the discount rate, by the time it changes it, it is usually anticipated in market interest rates. Market interest rates have already caught up, are already ready for that change. So it's not surprising, and I think it's quite nice that we get that effect. We also find that error correction term, the spread, is very small, but it is significant. And with simulations we do indeed find that the treasury bill rate and the interbank rate are tied together. The third element here is the cross-sectional spread of the interbank in the interbank market, and this I just want to mention because it is also true in the Eurozone that spreads in the interbank market do have an effect on the Eurozone rate. So the chairman has already warned me, so I shall. I do have one more results slide, but I think I'll skip that and go straight to the conclusion. Let's just go straight past these. So I'll give you the conclusions all in one go. Really just to emphasize at the start that this was an exercise in terms of finding things out. But it is important to realize that these overnight markets are potentially very important to the whole monetary system, the whole financial system. In the context of this conference, of course, one of the things we're much more concerned about is how finance gets to people across the country. The overnight market may seem very distant from that, but it's how the markets are anchored in terms of the payments mechanism and in terms of monetary policy. So what we find for Kenya is that the interbank market has developed over this 10, 13 years is really quite a deep and resilient market measured by the fact that different types of shocks do seem to be absorbed by the market pretty well. When we look at determinants of the interbank rate, it turns out that these determinants are really quite sensible. Other interest rates, we have demand, supply effects, central bank intervention, and so forth. And the conditional volatility that I passed by you, this was also quite encouraging, that volatility was not very persistent. It died away rather quickly. So I think in summary, the results of our investigation, the results of our research, suggest that this was a market which was really in quite good shape. Okay. Thank you, Mr. Chairman.